$900,000 house right now. How are you going to afford it in a year if they lower the interest rates to go to 3, 4, 5%? Some of these realtors that are being irresponsible just telling everybody, well, wait till the rates come down. If the rates come down, it's reverse market crash. You want that to happen to Venezuela? Like what happened to Venezuela to happen? Oh, it'll never happen. You're just fear porn, all this stuff. Really? People can't afford to buy a house right now. There's a reason why they're renting. You're not going to have a customer qualifying for the $1.3 million home. Yes, you have equity in your house, but even if you got equity in your house, you got to find a buyer. Buyer can't afford it. There's a reason why we have so many strikes going on in America right now. People are saying, I can't afford my life.
With less than 2 months of the year remaining, everyone wants to know, is winter going to bring real estate prices down? If you don't want to watch the entire video, the answer is maybe, but probably not. In Calgary, at least. Let's start with the data. We're not only diving deep into the real estate dynamics in Calgary, but we're also examining the macroeconomic state of Canada and what it signifies for our real estate future. Starting off with Calgary sales, total sales have registered a decline of almost 10%. A dip this significant can be attributed to several reasons, seasonal market fluctuations to broader economic factors. But before you start making any assumptions, it's essential to understand that this isn't just a local trend. Various cities across Canada have experienced similar shifts in sales dynamics. So why are the sales down? Is it the rates, recession concerns? What is it? It's actually super simple. Sellers are not willing to list because of two big reasons. One, they're locked into a low rate, and two, where are they gonna move? Looking at the bigger picture, as we predicted, Bank of Canada held their rates, but there is growing evidence of a slowdown. They did acknowledge that there are recession pressures mounting. There are also so many recent data points to highlight, but consider just a couple. Firstly, retail sales are slumping. This is a key macro data point to track because if the consumer pulls back, the economy is gonna follow. Secondly, GDP continues to trend negatively once we adjust for Canada's booming population. In other words, the recession is already here in per capita terms. Mortgage loan growth just hit a 40-year low. This is a crucial graph to consider. The 5-year mortgage renewal difference. This measures the payment changes for those renewing in their 5-year fixed term mortgages. Even though the request for 5-year fixed rate loans has dipped lately, this still makes up 40% of the total mortgage debts. Historically, over the past 3 decades, borrowers typically experienced a drop in their renewal payments, averaging a decrease of $70 a month for every $100,000 initially taken out. This has been a significant boost to household spending among other benefits. But the trend seems to be shifting. Currently, borrowers are seeing an approximate increase of $100 a month upon renewal, providing they choose a 5-year fixed term. The years 2024 and 2025 highlighted in the chart are particularly concerning. If the current rates stay the same, the payment difference could surge $200 a month for each $100,000 borrowed. This scenario may lead to a challenging conversation and can pose a substantial obstacle to household spending and consumer debt. The rate of mortgage delinquencies has stayed consistent over the past 3 months at 0.15%. While there has been a noticeable uptick in Ontario, the countrywide situation remains under control. Projections do indicate that these delinquency rates could potentially escalate to double their current amounts within the next 12 months. August saw an 18% increase in consumer bankruptcies compared to the same month last year. We haven't seen numbers as high since prior to the COVID-19 pandemic. That said, based on this data, it is anticipated that these figures might break those records that we set back in 2019 in the next few quarters. The saving rates for individuals below 35 years of age has plummeted to nearly 0 in the second quarter. This trend could potentially affect future housing market dynamics because this age group commonly accumulates savings for their home down payments. Alberta's sales to new listing ratio is above 70%. Comparing that to Ontario's sub 40%, this is great news, and it's encouraging for Alberta real estate, but it also limits the available options and continues to push prices upwards. Calgary has not only seen a real estate sale decline, but also a massive decline in active listings, pushing the average home price up by almost 4%. While Calgary shows a positive trajectory, metros like Toronto and Vancouver have been struggling recently, from an affordability crisis to market oversaturation. This is where Calgary, with its balanced market dynamics, offers a breath of fresh air. The city presents a blend of affordability, quality of life, and investment potential. While the entire country might be grappling with challenges, Calgary is well positioned to weather the storm. For potential homeowners, this is a time to act. The window of opportunity where you get value for your money and the promise of appreciation is open for right now. And sellers, well, with fewer homes on the market and prices inching up, there's potential for a very lucrative deal. As our city continues to grow in Canadian real estate hierarchy, it's clear that Calgary isn't just a contender, it's a leader.